But for usually husband and wife, they will skip the auction to purchase phase. They will go straight into a document called sales and purchase. Hi, my name is Kenneth from Keyquest Mortgage. So today we are going to share on decoupling. What everybody has been talking about decoupling or pop purchase, how does it work? So today I'm going to give you a framework and share with you how you can calculate your own decoupling before you even talk to a bankers, and what are the necessary information you require that you can engage on so that you know how to do up your calculation and know roughly after your decoupling how much cash proceeds you receive, what are the costs involved, what's the timeline you are looking at. So a few things to touch on decoupling is number one, you need to know your market value. So how do you find out your market value? So you can actually check with Keyquest Mortgage. We will be able to help you to get a desktop indication on your property valuation. So the information we will require usually is your property address as well as your built-in area. That means the size of your property. So that's how we can determine your current market value of your property. In order to calculate for your decoupling, there are a set of information which we will require. Example, your outstanding loan amount, your CPF usage on your existing property for both parties, example husband and wife, okay, including accrued interest. That's where we can do the calculation. Lastly will be what are the costs involved when you do a decoupling. You will actually need lawyers to represent the buying and selling, and basically you need two lawyers involved, one to act for buyer, one to act for seller. So there's two sets of lawyer fee. And valuation, when you apply the loan with a bank, there are valuation fees which will be incurred depending on market value. So usually it's a range of maybe $300 to $750 depending on your current market value. The higher your current market value is, the higher the valuation will cost. Okay, so next I will give you a framework on how you can work on your decoupling. So we can look at the screen. So number one is you need to determine your current market value, which we have run through earlier. What would be your current market value? So example for this case scenario which I'm presenting to you is that, example, your current market value is actually at 2 million. Okay, so if your market value is at 2 million, when you do a buy-sell, because most of the cases for husband and wife, the existing property is held in a manner of 50-50. Unless you have did some special arrangement beforehand, that means, example, husband is holding 90% or 80%, then the calculation would actually change slightly. So this is for most cases whereby in the scenario of 50-50% shares for each husband and wife. Okay, so 50% of the market value is at 1 million. 75% loan of 1 million is 750K. And the buyer's stamp duty involved, do remember, if your current market value is less than $1 million or below, the stamp duty payable formula is that based on your purchase price times 3% minus 5,004. That's how we derive the buyer's stamp duty at 24,600. If it's above $1 million, say example your purchase price is 2 million, it will follow the standard stamp duty is 4% times your purchase price minus 15,004. So this is actually been simplified calculation. There are actually, the standard calculation is slightly longer. If you like to find out on the standard calculation, you can always Google on IRA's website. Okay, and you need to know what is your existing outstanding loan amount to calculate your decoupling. And lastly, you need to find out how much CPF each of you have used on your existing property. Okay, so for a decoupling, it works similarly like you are buying a new property. So example, your purchase price, as we derived earlier, is at $1 million. So based on the purchase price is 1 million, so 5% down payment is quite standard. In the normal cases, if you are buying a resale, sometimes your payment structure is paying 1% to get an option to purchase and 4% to exercise. But for usually husband and wife, they will skip the option to purchase phase. They will go straight into a document called sales and purchase. For down payment for a sales and purchase is 5% to issue the sales and purchase. So you need a lawyer to actually issue out the sales and purchase documents for you. So that's where both husband and wife will head out to the law firm, get lawyers to prepare the documents for the sales and purchase, and you pay 5%. Example for this scenario, the husband is actually buying over the wife's shares. Okay, so basically the husband need to issue a 5% check to the wife to get the sales and purchase. Subsequently, during completion, that's where you pay your balance 20%. So your balance 20% can be cash or CPF. Okay, so you can choose either one. So if, example, husband still have quite a substantial or CPF in your CPF OA, you can actually use whatever amount in your CPF OA for your down payment. So similarly, when you buy a resale property, that's how the format works as well. Then of course, the LTV is actually capped at 75%. So based on 1 million purchase price, 75% loan is about 750K. Then we have to take note, because similar like you're selling a property, you might have an existing outstanding loan. For Ken and Barbie, Ken is buying over Barbie shares of 50%. Therefore, whatever CPF usage Barbie has used on this property, you need to return back to the CPF OA. So you can see over here, there is a deduction on Barbie CPF of 100K. And next is on the cash proceed. So for the cash proceed, how do we calculate? Is basically A is actually including the 5% down payment at the initial start and 20% down payment from the CPF, followed by a 75% loan. Okay, so it's A plus B. That's the total sum should come up to about $1 million. But you need to remember, because you have an outstanding loan which you are owing back to your existing bank. Okay, therefore we need to deduct that part. Your existing outstanding loan is 500K. So because it's under 2% name, so the outstanding loan we need to divide by 2 to determine how much did Barbie own to the existing bank, which is 250K. Okay, and CPF usage 100K. So in terms of your cash proceed, what you will be receiving is 650K. As you can see on the screen here, it's 650K. Okay, so basically it's A plus B minus C. C is your 50% outstanding with your existing bank. Okay, and D is that because Barbie need to return back 100K of the sales proceed back to CPF OA. So that's how we derive 650K. Okay, so for Ken, the new loan amount will be including the new purchase loan, which is 75% of the current market value, is 750K. And not forgetting, because Ken also still own a outstanding balance of 250K with the existing bank. So therefore, the total new loan amount would be 1 million. Okay? If you like our video, please hit on the like button and subscribe to our channel today.